Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And by golly, it is Michael Becker.
Hey, Paul.
How are you, Mr. Michael?
Things are good. How are things in the Old Capital world? We just wrapped up the Old Capital Conference.
Fantastic conference. Almost 700 people came to see Coach Lou Holtz explain some of his theories. Man, what I like about Coach Holtz was that he didn't tell the players how to manage apartment buildings, but he certainly told players how to hit folks with helmets and shoulder pads, and he went out there and coached a bunch of winning teams. And so the analogy really is that you are a general partner or a limited partner. You're not out there collecting rents or doing repairs or maintenance of the property. You're out there coaching your team. And so he made some great analogies to you being a general partner or a limited partner and getting the team out there to be the winning team on the field. So great conference, and we certainly appreciate everybody being there. Well, it worked out fantastic. And as you know, Mr. Michael Becker, who has done, will you tell me, Michael, how many apartment buildings do you guys own right now?
Today we own about 25, but we've done 38, about 8,000 units over the last 6 years or so. So we've been pretty active.
You guys are doing well. Don't forget, if you do want to get more information about Old Capital Podcast and want to learn a little bit more about how you can get into the multifamily business, the first thing you want to do is go on to oldcapitalpodcast.com website and download the 17-page white paper report about multifamily financing 101. Your lender should be your best friend. And so we got some great information about how to understand how apartment loans work and what you should expect. So setting expectations correctly is definitely the way that you are successful in this business. So go on to the Old Capital Podcast. And if you do have a second, please give us a 5-star rating on iTunes if you think the information that we provide you is educational and just better than what you could do it yourself. So hopefully we'll give you some inside information about what's going on. So today, we are excited to kind of talk about raising capital, raising limited partners' money, being a limited partner. So today I want to have Michael introduce our guest because I think that's pretty much all he does is that he raises capital. So Michael, I'm going to let you kick it off.
Yeah, so on the podcast today, we have Hunter Thompson, and Hunter is with ASIM Capital, and he's also a host of Cash Flow Connections podcast, which is how I found out about him. So straight from Los Angeles, Hunter Thompson, welcome to the podcast.
Hey, thanks again for having me on.
Yeah, Hunter, maybe, instead of me doing a long drawn out bio, maybe give like a little brief background kind of on yourself and how you got here and talk a little bit about kind of like your professional background as well as kind of your real estate investing background.
Sure. So, I think a lot of people, when they start the story, they talk about 2008. 2008 plays a role in pretty much everyone's story that's been in the financial sector in the last couple of years. For me, it was a little different. So I was in college in 2008 and was very insulated from the challenges that were taking place at the time because I didn't really have a lot of money in financial assets. Now, I was an entrepreneur back then, and one of the things I did as an entrepreneur prior to starting an event production company was I was an online poker player, was very fortunate there too. There was a massive bubble in the online poker world, mostly caused by someone named Chris Moneymaker, who is actually from a town about 3 hours away from where I'm from, Memphis, Tennessee. He ended up winning a tournament he paid $17 for, which got him an entrance into a $200 tournament, which got him an entrance into a $10,000 tournament, which he won for more than $1 million, and it created a multi-billion-dollar poker boom. And I was fortunate enough to be a part of that, a benefactor of that. So when 2008 happened, I really saw it as an opportunity to begin investing. And so I started just going all in on financial assets, learned about Warren Buffett, learned about Charlie Munger, and had success investing in stocks like most people did in 2008, but wasn't really until 2010 that I had a moment that was like 2008 for a lot of people, which is the European debt crisis. Basically, I had spent hundreds of hours, if not thousands of hours, studying the stock market, learning about day trading, etc. And then I remember watching CNBC, and out of nowhere, all anyone cared about was the Greece bond yields. And they were talking about how if the Greece bond yields remained below 7%, the S&P 500 was going to be fine. But if it went above 7%, the S&P 500 was going to collapse. And this was happening every single day, 600-point intraday swings in the Dow Jones. And I realized, the stock market, the reason it's popular is because it's a marketing campaign. It's not because the vehicle itself is amazing. It's not a very clear route to what most people consider financial freedom. And so this started my journey to learning as much as I could about what vehicles would actually provide low risk cash flow. Moved to California and was very fortunate in terms of market timing, of course, but also because of that market timing, started going to networking events where a lot of people had been wiped out, but the people that had been able to weather that storm were the ones that had an investment thesis that was set up to do that. And so I model my career off the way that they invest, and quickly was introduced to syndications, and that kind of led us to this conversation today.
Well, perfect. So kind of on the real estate, you're what I would probably consider a professional passive investor, as well as you also have a fund where you raise capital from others and JV with various GPs into different real estate investing vehicles. Is that accurate?
Exactly. So starting back in 2011 or so, I started investing in syndications. Back then, it was very challenging to raise capital because people were very scared. So even really high caliber operators had problems doing it. And so the fact that I was able to invest significantly allowed me to build some really high caliber relationships quickly. And then as I realized that this is an incredible investment vehicle, I started to build a due diligence process that was really taking the passive approach to investing to really the next and to the next level. And then as I curated that list of operating partners, we really started to form a business, leveraging, both the due diligence process, the curated list of operators, and then the ability to write large checks because of the investor base that we were growing.
Well, cool. Well, maybe we kind of take the podcast really kind of maybe two parts. Kind of first and foremost, talk through a little bit about from a passive investor standpoint. What are some of the activities that you think are good as far as like how do you identify high quality sponsors? What are some of the things you do to vet the sponsor first, the deal second, and then maybe we can transition over since you're on both sides of the table, now that you raise capital from others, what are some of the ways you go about, attracting that capital, some of the things you do to, communicate with the investors and raise money to be successful and actually get transactions done. So that's kind of first and foremost from a passive investor standpoint, how did you go about identifying some of the leads that you wanted to go partner with and invest when you're first starting out? And what are some of the things you learned kind of along the way?
Well, from a big picture perspective, I would say that the syndicated approach to investing, where there's a delineation between the passive investor and the active investor, I just find it very compelling, most specifically in large commercial properties. And the reason for this is the more complicated the vehicle is, like self-storage is a great example. It operates very much like a business. Multifamily is a great example. It is a business with real estate as a hard asset. The more complicated, the more value someone can bring to the table, the more it makes sense to defer to their expertise. And then if they're participating in a deal, they can more than make up for that reality. In all seriousness, just yesterday, someone asked me, how much return do you think you're giving up by being a passive investor? And I honestly, truthfully, I think it's actually negative. Like, you guys have a tremendous background in multifamily, for example. In a conversation we recently had, you said basically, when it comes to, getting advantageous loans, it's an unfair deal. It's all about who you know, how large the number of transactions is that you've been involved in, what your track record's like. And so I really like to find those really top tier operators that are best in class in their particular niche, whether it be that particular geographic location or that particular asset class. And having that passive approach has allowed me to be diversified across a lot of different asset classes, across a lot of different geographic locations. So one of the things you mentioned, kind of the due diligence process, I think if a passive investor thinks about it in this framework, that's going to help you a lot. If you just think about, there's 7 stages of this due diligence process. And if you just ask 3 questions about each, you're going to be well on your way to learning a lot about the passive approach to investing. So the first and most important is the sponsor. The second is the on-site manager. The third is the loan and financing. The fourth is the property pro forma and the previous performance of that property. The fifth is the market itself. The sixth is property-specific due diligence, like such as, the visual, how visible the property is from the road, for example. And the seventh is the legal documents. And I'm sure that we have some lawyers that are listening to this podcast right now. I'm not saying your job isn't important. It's on the list, but the legal documents only matter if you're going to sue someone. So it's really important to understand them, but it shouldn't be the main thing in your entire process. To answer your question directly, I'll give you just a couple tips in terms of the sponsor. We have a very stringent list in terms of 10 years in the business, taking 10 assets full cycle, $100 million or more under management. That's just where we think it's wise to invest late in the cycle. Generally speaking, it's about trust but verify. And I think anytime you can bring in third-party reports is really going to help that. So one of the things that I like to talk about is that anyone can claim they own a massive multifamily property. But if you pull the title of that property, you can do this on Chicago Title Company, RealQuest, things like that, less than $200 usually. Pull that title. It'll actually show you the LLC or the person that owns that property, whether or not the property is in good standing, are there liens against the property, and then you just need to verify that their claims are matching up with the reality. I also really like, when it comes to sponsors, a lot of people want to talk to the sponsors' investors, which is fine. That's usually kind of their friends and family who are willing to take those calls. I really have gotten a lot more out of talking to their third-party service providers. So let's say lenders, their insurers, their construction companies that they've worked with, just saying, how many deals do you think they have going right now? What's it been like to work with them in the past? Their attorneys, for example, people that have something to lose that aren't just their friends and family. At the end of the day, though, It's all about the gut check. I really want to see, should I be in business with this person for the next 7 to 10 years? And so everything we do from the due diligence process from that point forward is really trying to answer that question.
So obviously deducing from that, so sponsor first and deal second essentially is kind of in the pecking order of what you really focus on. As far as that, how do you go about meeting some of these sponsors like to do business with? If you're a passive investor, how do you go out and get networked enough to actually go meet a lot of these people that you ultimately then can vet and then get comfortable enough to invest capital into?
Yeah, this is a really good question. And unfortunately, I don't know if my answer is going to satisfy a lot of listeners. We basically, I'll put it this way, we're always looking for new sponsors, but in the same way that you guys are looking for a new best friend. I mean, truthfully, that's how we review that relationship. It's not scalable. It's not like if I receive an email from a sponsor who's raising some fund or something like that, the likelihood that we'll end up doing business with them is extremely low because of the caliber of what we're requiring and the fact that we view it as a true partnership. So the way that we have sourced those relationships in the past usually comes from a very, very limited amount of people who have a lot of trust in that say, you should go talk to this firm. And, there's never been inbound requests that I've received that's resulted in us doing business with them. So I know that's not the answer you're thinking.
Trusted sources, essentially.
Exactly. It's just, if we do 3 deals in 2018 or 2019 or 2020, those are going to be with people that we've been working with for years, and I think investors like to hear that as well.
So if you were on the other side of it and you're new into this, you haven't invested in first syndication, what would be some tips about how do you go out and start meeting people that you should then go through and vet and make sure you get comfortable with? Where would be some of the most likely places to meet which you consider high quality sponsors?
Yeah, well, I mean, I think that the key there, and just saying it out loud has kind of re-clarified it, but the fact that our sponsors have been referred by people that I really trust, you have to find those people that you really trust. And those people that you really trust, they're usually very successful individuals that are very busy people. So what I have found, and this is actually something I talk about in the book, is really finding a way to motivate high performers in the real estate business to help you. Attracting mentors that are extremely high performing, that are willing to show you the playbook, the type of people that are going to say, you should actually talk to this person. From my perspective, mentors, like the most easy way to attract a mentor is to realize that you're going to have to do it on your own and show anyone that is in that high performing caliber that you've got all the momentum in the world, that you have a real sense of urgency about attracting and completing your goals and a very clear outline of what you're trying to do in the real estate business, and that you're obsessed with growth and obsessed with learning. And that alone will attract the right people to help you give you that type of information.
All right, great. So as far as kind of switching hats a little bit, so as far as you have a fund, you raise capital from other people. What are some of the things that you think are key when you're out there trying to attract capital? The investors that actually invest capital with you, what are some of their drivers or their triggers, the questions that they have that you must answer for them to be able to actually invest with you? Anything kind of jump off the page, top handful of things?
Yeah, I mean, well, first of all, I think that the way that most people think about raising capital, they kind of think of it like they think of themselves at the center of the circle, and then they're going to go out to their mom, they're going to go out to their doctor, they're going to go out to their cousin who has a bunch of money, and they're going to try to convert them to be real estate investors. And it's true that you can go out and convert these people, and they may give you $25,000 if they already know and trust you, but they're not really giving you that $25,000 because they think it's a great investment. They're doing it kind of as a quasi favor. That can get you your first $250,000. That can get you maybe even your first $1 million. But that's not a scalable way to build a business. And so the book that I just finished writing, which is raisingcapitalforrealestate.com, it's basically about creating a funnel that attracts people and nurtures them so that you can go through that entire process from people that are already interested in investing in the type of deals that you have access to. And so it's really about creating content. And obviously this is something that you guys have done an incredible job of, which is attracting people that are already interested, nurturing them through content creation, whether it's article writing or podcast interviews that you've done, etc. Drafting an ebook, which is an incredible call to action, so that by the time they do talk to you and you do answer these frequently asked questions we can talk to you about in a second, they're already well along the lines of understanding the entirety of the business. You know, I think that people make the mistake of thinking if they just call someone, they're going to be shocked at how incredible their deal is. They may be shocked, but they're going to be shocked because they've never considered investing in something like that before. It's not a very good way to have someone invest and then again and again and again over and over again. So, you know, as far as frequently asked questions, one thing that I always like to say is that if you're going to be doing something over and over again, you should have a system for it. I mean, just having a system itself is a really great way to boost credibility because it implies that you've done it over and over again. So like referrals, for example. I have 3 people that are willing to take investor calls and respond to investor emails that have been great investors of mine for many, many years. And those people, they are always the ones I refer the investors to and always take care of anyone that's helping out your business. So every year I take these guys out to dinner once per year and take them to a really nice restaurant and thank them. You know, that's one way to answer frequently asked questions, which is referrals. I think, ask me anything. I'd be happy to answer your question that you have. I'm sure you guys have gotten a lot of questions from investors as well.
So I think that's a good start. You know, I echo what Hunter was saying. When we raise capital, you know, I think of it being like a magnet. I want to attract people towards me versus me having to go out and meet a whole bunch of random people, or like you said, you know, try to convert the non-believers into real estate investing. I think that's certainly swimming upstream a little bit more. So I found that, you know, the first people that tend to invest with you, 3F rule, right? It's friends, family, and fools, right? The people, right. You know, they're friends, family, they know you a long time, or people just don't know any better. Because why would they take a risk on you when it's your first deal? Because it's generally a higher risk proposition, but you know, everyone starts from zero and then has to grow and do their first deal. So I found it's a lot easier, honestly, raising money from people that are not necessarily strangers, but people that don't have as intimate of a personal relationship with you. Someone that you meet at a conference, or maybe someone I meet off a podcast. I form a relationship over a series of meetings or phone calls or whatever. Yeah. And then, you know, 6 months down the road, a year down the road, then they're qualified and maybe invest with us. You know, one of the things I heard from Robert Helms, from the Real Estate Guys, you know, spoke at several of their syndication seminars. He said, you know, your friends and family, you know, sometimes they don't like to trust you as much because they've seen you kind of drunken in your underwear, right? They've seen you in these situations where you maybe aren't your professional persona. You have your personal persona and your professional persona. So the world out there, these people that you meet at conferences, they only know you from your professional persona. Not that, you know, my dad, for example, I asked him to invest in one of my deals once, and it was really like pulling teeth. And at the end, he kind of told me that, hey, I'll do it if you really need it. And I was like, well, I don't need it. But, you know, my dad thinks of me as a 16-year-old punk kid, not the professional real estate investor I have become. So that's a little tangent as an aside.
Can I trademark that friend, family, and fools line? Right. Or is that somebody else done that? I like that one.
So, but that's really it. So some of the things like Hunter mentioned, which I think are impactful, and I'll kind of repeat is, you need to have some sort of platform to go out and start speaking to people that are interested in real estate investing. So we have a pretty big platform. So does Hunter with our podcast. That's a good way. But, another thing is just maybe hosting like a local meetup and having people out. And, maybe be a guest speaker and then start building off of that. And then, kind of over time, if you're consistent with it, tends to grow. And, you don't have to be the expert on everything. You just can bring out an insurance person or a banker or a real estate broker or whoever to come speak about their particular topic. And the other thing I kind of really realized personally was when you're raising capital, a lot of this stuff is relative. If I've done one deal and you've done zero, I'm 100% more experienced than you. So, a lot of this stuff is kind of relative as well. So I don't know if you have any other just kind of general comments on that, Hunter, before I kind of move on to the next topic.
Oh, I mean, I think it's an incredible time to build this infrastructure. It's incredibly asymmetric. I mean, the reason that the podcast industry is blowing up because it's an incredibly favorable way to spend your time. I saw some numbers recently where by 2014, iTunes had received about 7 billion downloads. By 2018, that number has gone from 7 billion to 50 billion. And I think as investors, we look at that and say, wow, there's a massive bubble in the podcast space, but nothing could be further from the truth. The reason that it's happening is that right now I'm having a conversation. I'm at my office. It's not like there's a team of 20 people that are speaking in my ear telling me what to say and what not to say. It's an incredibly favorable on a risk-adjusted basis. So if you're thinking about starting your own podcast, I highly suggest it. What's the worst that can happen? I mean, and also something in terms of content creation, I'm a huge fan of time batching tasks. I feel like if you're going to do anything, it should be done in increments of 60 to 180 minutes. And so if you're just getting started in terms of building this platform that you were talking about earlier, take 180 minutes to write down 100 topics of potential articles that would be compelling for your business. It doesn't even have to be real estate related. This will work on all types of businesses. Write 100 potential topics. The reason I say 100 is that it will eliminate procrastination because you'll know that a lot of them will be trash, but that's fine. Doesn't matter. Write 100 topics, rank them in terms of 1 to 10 in terms of how applicable they are to your business, put them in Excel, sort by that number, and then write an article about the first 10. And just going through the process of writing that article is going to solidify and clarify and codify your ability to communicate to other investors. That alone will make up for the time doing it, not to mention all the potential traffic that you can have to your website, and as a super, super important way to establish credibility. If you ever talk to an investor and you find that they're asking the same questions over and over again, write an article about it. After you get off the phone with them, send them that article. That looks very, very good to an investor.
So when you're meeting someone for the first time, obviously maybe they have heard you on a podcast or read an article or a blog post or whatever you have had. Do you have any sort of reference material you tend to like to give out that kind of eases the transition from prospect to actually investing? Is there anything along those lines that maybe you can recommend to the listeners that if they're thinking about doing it, they should put together?
Yeah, I mean, gosh, that's a great question because those first it's like in the conversation you have with someone, they're trying to establish whether or not you're credible within the first 5 or 10 seconds. If someone joins your mailing list, they're trying to establish if you're credible within the first 1 to 3 days. And so those first couple emails, those correspondences you send them are really critical. So whenever someone creates an account on our website, they're going to receive an email from us requesting a call. Now, we use 506C structures, meaning that we don't necessarily have to have a call with all of our investors, but I really like to build that relationship. Second of all, I will send them an automated email with our most recent ebook, which is about passive investing, and I'll also send them a list of 3 podcasts that we've done, one of which I was the guest on. So they'll give a good understanding, a little bit me as a person. If they take the time to listen to that content and read that ebook, by the time they're interested, and if they do jump on that introductory call, that first call, it's very streamlined. And if you're going to have hundreds of investors like we do, and you're going to have hundreds of these calls, it's really important to make those calls really, really efficient. So just creating that content, using it over and over again, making it evergreen, and constantly building that credibility by reusing it, repurposing it, is a great way to spend your time as a capital raiser.
Yeah, I couldn't agree more. I do very similar things with what we do, and kind of have my basic business model. I can communicate in like 7 minutes or less on a telephone call.
Right.
So I think you get your pitch really tight, and you do this enough, you'll know exactly what people want to understand, because people need to kind of basically understand, generally who you are, what you do, what you target on, the types of returns that you generally target to be able to produce. And ultimately, really, it's like, once they kind of trust you and understand the market, really at the end of the day, it's like, well, if I give you this much money, how much do I get back, and what's the timing and source of those cash flows? And those are the kind of things you need to be able to communicate in a very condensed, effective way. So I think any sort of materials in and around those things, those are kind of the key decision metrics I think that people go through in their mind, whether consciously or subconsciously, that they need to know those things before they actually end up writing a check to you and investing in a deal. You mentioned like yourself that you have hundreds of investors. I think I have north of 700 unique investors at this point. We're going to do almost 1,200 K1s for the 2019 tax return and 2020. So, we have, a bunch of deals that we do monthly reporting on. So communicating to investors on a regular basis is a big part of what I do month in, month out. Do you have any sort of comments or best practices that you do when you're communicating once you actually have acquired a property and you're ongoing operating, both from like an ongoing kind of just monthly or quarterly reporting standpoint, distributing cash, and then maybe more like on an annual basis or around the tax return? Any sort of best practices you could share?
Yeah. So, first of all, as soon as we receive a wire, we send out a thank you card. I think that really starts the relationship on the right foot. That's prior to even signing the countersigned documents. I think just that's a great way to spend that $1.50. As far as the reoccurring communication, we have quarterly reporting, but I think the really important part of this conversation is that once you establish the date at which you're going to provide that quarterly report, that needs to be kept. Because here's what happens. If something goes wrong at the property level and you're trying to scramble and figure it out before you issue that quarterly report, that's a very bad habit to be in. And your investor base is going to pick up on it very quickly, and they're probably going to assume the worst. So for me, even if we've been very fortunate in the deals that we've invested in, but let's say something weird takes place, an elevator breaks at the property, okay? We need to communicate that to investors. We need to do it on time, and it's much easier said than done. As an investor, if you've ever received negative information, trust me, it's much, much harder to send that negative information. And so you'll find if an operator is struggling, they'll slowly start to veer from that original schedule. You don't want to do that. That's kind of a good tie-in to, your challenging decision algorithm, which is something I talk about. Anytime you have a challenging decision, it should be viewed through the investor's lens through the long term. What's in investors' best interest over the long term? And if you guys have 700 plus investors, we have about 300 investors. These investors can change your entire life. They are the mechanism by which all of the dreams that you have about your future goals in the real estate business are accomplished. So just considering them first is really, really important. And every communication should make that very clear.
Yeah, couldn't agree more. I'll kind of expand upon one thing Hunter said. I think the most important thing to do is when you set out proper expectations, you say, hey, I'm going to report monthly or quarterly like Hunter does, or monthly like I do, that, hey, by the end of the month, I'm sending out the prior month's report. So you need whatever that timeline is and whatever the interval is, you make a commitment, you need to kind of follow through and hold that commitment. Not saying that you can't be a day late here or there for whatever reason, but, you need to make sure you communicate on a expected interval and, that whatever you lay out, you keep. There's certain levels or different types of communications. And one of my little sayings, Hunter, which I like to say is, there's multiple ways to communicate with the investor. The best way is with a check and everything else is secondary, right? So if you consistently pay out distributions and you do that on a regular basis, people tend to cut you a little bit more slack than if you're always kind of promising it's next month type of thing. So, if you can get in these types of opportunities like I have, and I believe like Hunter has, that produce, current cash flow, and you'll be able to, pay that out. Those are ways that, people feel secure when I don't literally send a check, but like they open their bank account on the 15th of the month and they see that ACH hit. That makes them feel comfortable that, you're taking care of business and you have enough free cash flow to pay out. I'm not saying that, you don't hit challenges along the way where something happens that you can't pay out here or there because you have an unexpected capital item pop up. But that is certainly true in my experience. Kind of wrapping up here, Hunter, I don't know if you have any other things that we haven't really talked about that you want to expand upon any of the previous topics, or then, certainly at the end, I know that maybe you talk about how people can find out a little bit more information about you. I know you have a podcast, and it sounds like you're in the process of launching a new book. So maybe give a little information about people can find more information about you if they want to get to know you a little bit better.
Yeah. And first of all, again, I appreciate letting me come in on the program. It's an honor to be on. You had so many tremendous guests over the years. So thanks again. But yeah, just to circle back with what you said about kind of communicating and sharing with investors on a regular basis, investors, especially if you're dealing with accredited investors, it doesn't take that many to do some pretty remarkable things in the non-institutional space. If you have, let's say, 500 investors that are investing $75,000 a year, that's like almost $40 million of equity. So every investor is incredibly valuable. So if you can think about ways to just increase their experience, whether it be a little gift, last year we gave out hot and cold coffee cups. This year we gave out these little wireless chargers that are branded. This probably cost $30, but it really helps them, solidify that relationship. Or scheduling recurring annual calls with them is burdensome, but it's just a great way to spend your time. So super passionate about all our investors, very grateful for them and just making that clear. The book that I'm writing or has just finished writing and is going to be available starting November 2nd for pre-sale is Raising Capital for Real Estate, How to Attract Investors, Establish Credibility, and Fund Deals. I was at a conference recently that was about raising money, and I know that the industry is kind of blowing up right now. There's definitely some risk to that, but in terms of once you have the deals locked in, you've gone through your due diligence process, when it's time to close, you need someone that can bring the capital. So the way to find out about the book is raisingcapitalforrealestate.com.
Perfect. Cool.
No, it's just some great information. I was just taking a bunch of notes on this business. Again, it's kind of an interesting position these days. A lot of people try to, at least they think to try to do it the easy way by putting opportunities online and trying to not build the relationships as deep as you guys have built your relationship with your investors. They try to short circuit it and they try to give opportunities online. And I think that is not the right way of doing it. I think building the relationships over the period of time and heavily communicating with people and giving them value added information definitely keeps them part of your investor pool. So guys, great information. We appreciate everybody getting together. Again, Michael, anything else we want to throw in there?
No, yeah, Hunter, appreciate you coming on. I echo, I think Hunter and I and the way we do business are seemingly very well aligned in most aspects. So I definitely appreciate him saying the same stuff I'd say in a different way. So that's always helpful.
Great to hear.
But, I think to Paul's point, when you're out there raising capital, certainly what I found, I think a lot of people thought, in 2012 when the Jobs Act passed, that there's going to be a magic shot when the crowdfunding came along. You just put your opportunity on a platform and magically it's going to get funded. And that is not the way it works in reality. People do business with people they know, like, and trust. And you got to go work to, one, establish a relationship, two, provide them the basic information they need to know about kind of your opportunity and what you do, three, get them to kind of know, like, and trust you. And then finally, once you do all those things, I think they're finally qualified and ready to actually give you capital, invest in your deals. So it's really hard to shortcut it. So, being able to attract those people to you, have some material in place to answer the kind of the basic stuff in an efficient fashion, because a lot of the stuff, like Hunter mentioned, is very repetitive because people generally all want to know the same stuff. So if you kind of get ahead of that, systematize it, you become more efficient. And then once you do that, the opportunities you have to go out and raise will become a heck of a lot easier than if you're just trying to do that on the fly when you actually have capital at risk and your reputation at risk when you have a deal in escrow.
That is absolutely correct. Hunter, thanks for your time. We appreciate it. Michael Becker, always a pleasure. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.